Welcome to Ahead of the Curve from K33 Research. Today is June 23rd, 2026. A written version of today's analysis is available at k33.com/research. Bitcoin is once again testing its 200-week moving average, and the market currently looks stuck. Selling pressure has eased compared to a few weeks ago, but demand remains weak. ETF outflows are slowing, trading activity is approaching multi-year lows, and institutional participation remains subdued. The result is a market with very few committed sellers and very few committed buyers. That balance can persist for a while, but it rarely lasts forever. The important question now is not what happened over the past week. It's what could happen once conviction returns. The first thing investors should pay attention to is how passive the market has become. Bitcoin fell 6% over the past week and remains close to its 200-week moving average. Normally, a move of this magnitude would be accompanied by heavy trading activity. Instead, spot volumes continue to decline and are now among the lowest levels seen over the past year. This tells us that most market participants have stepped to the sidelines. Few investors are eager to buy, but few appear willing to sell after a 50% drawdown either. In this type of environment, relatively small flows can have an outsized impact on price. That increases the risk of sharp moves once sentiment begins to shift. ETF flows tell a similar story. Outflows remain negative, but the pace has slowed considerably. Earlier this spring, Bitcoin investment products experienced some of the largest outflows on record. Those outflows were a major driver of Bitcoin's weakness. Today, the situation looks different. The selling has not stopped, but it has moderated. In fact, the pace of outflows over the past 2 weeks is only a fraction of what we saw in May and early June. That has helped stabilize the market. At the same time, one-year net flows into Bitcoin investment vehicles have now turned negative for the first time since late 2023. That reflects a significant deterioration in investor demand and highlights how challenging the environment has been for Bitcoin exposure. Institutional positioning remains equally cautious. Open interest on CME, the largest institutional Bitcoin futures market, continues to trend lower and is on track to reach its lowest level since October 2023, following this week's contract expiry. Futures premiums have improved modestly, but not enough to suggest a meaningful return of risk appetite. The message from institutional markets remains straightforward. Investors are not aggressively positioning for a recovery. You see a similar pattern in derivatives more broadly. Perpetual funding rates moved higher over the weekend as traders cautiously added long exposure, but overall positioning remains muted. Meanwhile, options markets continue to reflect unusually defensive sentiment. Traders are paying a significant premium for downside protection, with short-dated options showing levels of caution last seen during some of the most stressful periods of the 2022 bear market. The market is not positioned for optimism. If anything, it remains positioned for disappointment. Another topic worth watching is strategy and its growing preferred share structure. Concerns around the company's dividend obligations have intensified as its STRC preferred shares traded below $90 for the first time. Some investors have started discussing the possibility that Strategy could eventually be forced to sell Bitcoin to meet its obligations. We think that concern is premature. Following a recent capital raise, the company has enough cash reserves to cover roughly 10 months of dividend payments. The more likely risk is a future dividend suspension rather than forced Bitcoin sales. Still, the episode is a reminder that some of the most important risks in today's market are increasingly tied to financial structures built around Bitcoin rather than Bitcoin itself. The final piece of the puzzle is macroeconomics. Last week's Federal Reserve meeting under Chair Kevin Warsh reinforced the market's perception that interest rates may stay higher for longer. Investors are now pricing in more than one rate hike before year-end. That shift in expectations weighed on risk appetite and contributed to Bitcoin's weakness. Looking ahead, this week's US GDP and core PCE inflation data will help determine whether those expectations continue to build or begin to reverse. In the current environment, macro remains one of the most important drivers of market direction. If I had to summarize the market in one sentence, it would be this: the aggressive sellers appear exhausted, but the buyers have not yet returned. That's creating an unusually quiet market near a critical long-term support level. History suggests that periods like this rarely remain quiet forever. To summarize, Bitcoin remains trapped in a fragile equilibrium. ETF selling has slowed, but demand remains weak. Institutional participation is subdued, sentiment remains defensive, and macroeconomic developments continue to dominate the outlook. The longer this balance persists, the greater the potential for a sharp move once conviction returns. Thank you for listening to Ahead of the Curve from K33 Research. Subscribe for future market updates and visit the K33 website and go to the research section to read the full report and explore our latest research.